Hello everyone, welcome back to my channel. So in this video, as part of the wrap up of the recent challenge that we went through, I want to talk about the top 5 things that I learned during this challenge, and because this will also be useful for many of you who wish to embark on this journey of options trading, and especially the wheel strategy. And this will be a useful guide for all the landmarks that you are bound to face as you go through your learning in terms of options trading and especially the wheel. So without further ado, let's go into it. But first of all, as an introduction, and for those who are not aware of what the strategy is about or the challenge itself, so basically as an overview of the wheel, step one, you basically sell a cash secured put. You sell a put with cash as a collateral against or on a stock, being an individual stock or an ETF, and you collect premium upfront, and then you wait. And if the stock continues to stay as it started, as when you open the position, continues to stay above your strike price, you keep the cash once the option matures and there are no further commitments. But if the stock ends up below your strike by the time it matures, you are assigned the shares, and then goes on to step number 2. You get the shares, you are forced to buy them at the strike price, and then we move on to step number 3, in which we sell calls to continue to collect premiums, but instead of using cash as a collateral, because now you own the shares, you use the shares as a collateral for those calls. And so you continue to collect premium until the shares then are sold, and then that happens when the price recovers and goes back up above your call strike. And once that happens, the shares are sold because you are forced to sell them. The call options are assigned, and then you come back to step number 1 and repeat the process. So this is a way to continuously collecting premiums in a very consistent way. And for those who already follow my channel for a while, I started about 2 years ago a challenge in which I attempted to earn 100,000 US dollars just by using the wheel, and it took around 2 years. First we started with individual stocks because of the small account size, but then eventually we proceeded to use ETFs because they have several advantages that I will cover also in this video. And so yeah, basically that was the goal. We then proceeded to show with the account statements that this goal was surpassed, and this happened in late last month in May. And yeah, so let's move on to the first one. The first lesson that we take away from this one is that, as you can imagine, because for those who follow my channel saw this trend then that I eventually adopted, the wheel, and this is the first lesson, the wheel works better when you use options on ETFs than options on individual stocks. And there are a few reasons for that. So the wheel, first and foremost, focuses on selling options, which is effectively a bet that the stock or ETF's volatility will remain low over the life of the option. And so price will be, or at least we are making a bet that the price will move as little as possible, which will allow the option to expire worthless, and so we keep the premium without any further commitments. Now, as a side note, I must say that there is a trade-off to consider here, and it's because of this. We know that more volatile stocks, because as I mentioned, stocks are a bet on volatility. Stocks which are more volatile are better to be trading options with if you are the options buyer, and so that's why the premiums that they yield are higher, because more volatile stocks are more in demand by the option buyers. And so, but this also means that if you are forced to buy the shares, you may tend to keep the shares for longer because more volatile stocks tend to take longer to revert back to the strike that you want to sell the shares at, which is obviously the strike of the short call. And so this might be okay if you want to buy and hold the shares, but the wheel is not about a buying and hold strategy. You can use it as a basis because you can buy the shares at a discount by selling puts, and then you won't use the calls. You won't sell calls to eventually sell back the shares. You can keep the shares for yourself, but that's not the purpose of the wheel. And so, coming back to our point, sticking to the low volatility shares is the reason why options on ETFs are better. In particular, the ETFs on the main indexes, such as the SPY, which follows the S&P 500, the Qs on the Nasdaq, and also the IWM on the Russell 2000 is a bit more volatile, but still it's one of the main indexes. And another critical advantage that all ETFs have is that being a group or a set of stocks based on shares of individual companies, or also ETFs being based on some sort of commodity, their value will never go to zero, because if they are ETFs of individual companies, even if one company goes bankrupt, it will be basically replaced by another company within the basket of shares in the ETF. And as you can imagine, commodities never go down to zero, because gold, silver, oil, and cotton, food, stuffs, these commodities can never reach zero because there is always some sort of demand for that. And so this also takes some of the risk off the table for the wheel trader, because if you sell a put, you are fully exposed to the downside risk of the stock or the ETF, because if the stock goes to zero, you will be forced to buy the shares at the strike price, and so you have the entire potential loss goes all the way down to zero. But with ETFs, because they will not go to zero, and this is something that is certain, they will not go to zero, you are somewhat more protected against that potential outcome. And there are many sorts of ETFs. I will show you later also a very short list of some ETFs that I use sometimes. But this fact that they cannot go to zero cannot be overstated enough, because the wheel requires, as I mentioned, being fully exposed to the downside risk of the stock. And so if a company goes bankrupt while you have a put on the stock, you get 100% loss. And of course this never happens with ETFs. But because you have many ETFs on many different kinds of assets, you can easily remain diversified. And not only that, if you want, because this can be an ETF that you really would like to keep for the longer term, you can pivot. Instead of selling the calls, as I mentioned, you can just pivot to a buy and hold strategy. And you, instead of selling the calls, you continue to sell more puts so that you can buy more shares at a discount. And this is also an important point to make, because this is probably, for most investors, this is the only way you can get access to these ETFs, because these ETFs are only available to be bought and sold directly if you are a US investor. But if you are not, you cannot buy or sell them directly. You can only buy or sell them through options. And so this is a way of you to get access to these ETFs for a buy and hold strategy. But moving on to lesson number 2, and I already discussed this further when with a friend of mine, is that the wheel excels with a larger account. And if you have a small account size, I would say that the wheel is not really an appropriate strategy because, as I mentioned, when you sell a put, you are fully exposed to the downside of the downside risk of the stock. And so the trading platform that you use, whatever it may be, it will require you to post as collateral the entire price of the entire strike price of the option times 100, because you will be forced to buy 100 shares of the stock if the option gets assigned. And for some ETFs, especially for ETFs, this can end up being quite expensive because there are no penny ETFs, just like there are penny stocks. And this makes it even more the case for puts on ETFs, as I mentioned, because of course they have larger price. And so instead of the wheel, I would start again. If I would start again with a small account, I would probably use credit spreads, credit spreads, because, and I can show an example here. If we go here to my account, you probably already know the graph of short put. This is basically when you sell a put, you have this profit profile. So this line goes all the way back to zero, or even to the negative, because you are fully exposed to the downside risk of the stock. So you lose all your investment, and this is when it stays in the green, stays in the profit. But and of course, if for example I sell this put with a 717 strike price, this is in dollars, my platform or my broker will ask me to post as collateral close to 62,000 euros. This is euros, this is dollars, so that's why there's a difference, which is basically the conversion of $71,700, this amount. But if we go for a put credit spread, means that I will buy another option which is further out of the money. Let's just say, for example, in here I will buy a 716 call. I will buy a 716 put, and the profile goes like this. Now, because I bought this one, if the stock ever goes below 716, I will be able to exercise this put and sell the shares that I bought at 717. And so I will have only a loss of $1 per share, times 100 will be a loss of $100. But because of this, and assuming we are using a margin account, and this is something that is very important, that's why my margin impact did not change when I select this put. If you are using a margin account, and so you are allowed to use leverage, your capital commitment will go down to only $100, because $100 is the maximum loss that you can take if you use this strategy. And so this is the situation. And now when you have this kind of structure, this kind of profit and loss profile, what will happen is that in terms of your probability of profit will be a little bit lower, because you receive less premium with this. All right, keep that in mind. In this case, you would even receive a small loss because of the price. But keep in mind, the price, in this case, you cannot keep into account these prices because the market is closed, so the bid-ask spreads are extremely large. So I will not use this one. But in this case, you would always receive a credit, because you are selling an option, you are receiving the premium of an option which is closer to the money than the option that you are buying. So don't mind too much on the prices. Even if you use this option, you will receive some money. A small amount, but you will still receive it nonetheless. And you, of course, because you receive a small net premium, what happens is that your probability of profit ends up being a bit lower, because you can still be assigned and still get some profit if your premium is not fully offset, and because of course you bought protection, so you got a net a smaller premium, and so the probability of profit is a bit lower, but still, because you got protection, you are in a more favorable position in terms of the use of your collateral. And the wheel will have a bigger probability of profit because it's fully exposed to the downside, and that means that you got a better premium. But in terms of the probability of assignment, is equivalent, because this put that you buy does not really matter. What matters is that whether this put gets assigned or not, because as long as this put is not assigned and you keep the entire premium, that means that this option dies without value, and that means that all these puts beyond that or below this in terms of strike will also die. So you won't be having any further concerns about it. What happens is that the probability of assignment of this option is what determines the success of this strategy or not. Now, having this in mind, you can see that with only $100 of collateral, in this case, if you have only a 1,000 account, you can use 10 spreads like this. Again, like I mentioned, with the margin account, because if you have only a cash account, your broker will still require you to post the full collateral of the put that you sold, because there's a point in time in which there's a situation in which you may decide, or you may forget, or the option you bought is not automatically exercised, and you need to have the money available to buy the shares from the short put. And because you cannot have a negative balance, you need to have that amount in hand to pay for the shares. But with the margin account, that is not necessary. And so in the situation, if you use the wheel on a small account, even if you have, for example, a 5,000 account size, and you want to sell a put on a $50 ETF or stock, you can only sell one put. And if that happens, you sell the put and the stock plummets, you can be locked down for some time, meaning, and showing you in here what I mean by lockdown, is that if you are assigned, for example, at 717, all right, you buy the shares at this price, but then if the price comes all the way back to here, to 684 or something like that, what will happen is that you will try to sell a call at least at 717 strike, but you won't get any premium out of it. And because your cash is all consumed by the shares that you bought, you have no way of doing more trades. You don't have any way to sell more puts on other stuff, or even in this ETF. And because you cannot sell any calls with a strike, which you would like to do, at least breaking even on the price that you bought the shares, because you get no premium, you are basically locked down and you cannot do any more trades unless you further extend the maturity, but we'll get to that. And so to avoid being this situation, it's important that you diversify as much as possible, and you can only diversify using the wheel if you have a larger account size. Now, moving on to the next reason, and this also a reason that I would a bit more complicated to explain, but I will use some examples to show you what basically I mean by this. Monthly options are safer than weekly options, and by extension are also safer than zero DTEs. This has to do, and I don't want to dive too much into this, because the conversation or this presentation will become too complex. I want to spare you the complexities. I will save the complexities of this for another video, but basically uh, the because this has to do with the Greeks, the option Greeks, and I will explain the Greeks in another video. But basically, what happens is that if you use a 0DT option, you get an upside, you get an advantage, which is if you sell only 0DT options, there's one advantage is that your premiums, the premiums that you will get, will compound on a daily basis, and so you will get more. You will get to deploy more premium every single day because you continue to accrue premiums every day because your options keep expiring at the end of every day. And so this will, if you continue to accrue premiums and your options continue not to be assigned, your puts continue not to be assigned, this will translate in a very progressive growth and a very good paced growth of your account size, even if you don't do any deposits. Another advantage that I forgot to say to mention in here, but I can add in here, and this is not unimportant. This is also a good advantage to have, but is that if you sell 0DT options, you face no overnight risk. And so you finish your day, your options expire, and you can sleep well at night knowing that you are no longer exposed to the market as long as your puts expired without value. And you can sleep with the security or the safety that and the assurance that you are not exposed to the market, and whatever happens overnight, the next day you will be able to deploy your cash with without being caught unaware of the reality of the day. And this is an advantage that no other maturity has, only 0DT options have. But what I mean by this is that, of course, there's always a trade-off with options, and one bad day, a bad loss on one day means that you will be assigned, and especially given the current times that in which we are living in, if the stock starts to fall from all-time highs, and this is where you will be, and your strike on a 0DT option will be very close to the price of the stock. And so if the stock is at all-time highs, your strike will also be very close to all-time highs. And so if the stock starts to crumble because of a pullback, a correction, or even if we are about to enter into a bear market, you will catch the stock with a price at the very beginning of the downturn. And because of that, if you put all your eggs in that one basket, as I mentioned in the previous slide, you are more likely to get locked down for longer until it recovers back completely, and you need a full recovery to get your money back to break even. All right. With weekly options, this is not the case. You will have a bit more. You still get some compounding, of course, not as much compounding frequency as 0DT, but you still get some, basically four times per month. But in this case, you have a little bit more security because your price will be further away from the current share price. So your strike will be further away from the current share price. So it gives you a buffer against bad days. It will take more bad days for you to be assigned, and as we all know, the longer the down days continue to occur, the less likely it becomes that the following day will also be a down day, because the market eventually starts to recover, especially in the case of the ETFs on the main index. This does not necessarily apply to stocks, but in case of ETFs, that's ETFs on the main index, such as SPY and Qs. This is just basically what happens all the time. But if you are assigned, even though those bad days continue to pile up, if you get assigned, you get a better discount on the price because you bought the shares when the downturn is already began for a while. You are less likely to be locked down because of that, and because you bought with with a better discount. First of all, you don't need that much of a recovery to break even, but you can also think, all right, if these are options on the queues always return back completely to where they were, and new all-time highs eventually continue to be beaten. All right, I will start to use a higher call strike than the strike of my puts, so I can still get some capital gains while still collecting reasonable premiums. And that is why I think that probably the best alternative is monthly options. You get slower premium compounding because you basically compound your premiums only at least once per month, but you get far more cushion. All right, because when you get assigned, which is much more unlikely, but still, if you get assigned, you get an even better discount. And this only happens when the downswing is already happening for quite some time, and that's why you buy at a discount. You allocate less money, so you are less likely to be locked down. And then, because of this, and because you sell monthly options, and if you sell only monthly options, the stock has a lot of time to recover completely, and so I don't think it makes any sense to sell calls with the same strike that at which you bought the shares. No, it makes sense because the stock has time to recover. These are monthly options. It almost always makes sense to sell calls at a strike above your cost basis, because it's very advantageous to be positioned for capital gains. The returns from capital gains are always higher than the returns that you have on premiums, and so for me there is no way I would get this opportunity of having bought a stock on a good discount. There's no way I'm going to let this one go without having the opportunity to get some capital gains. I will give you an example of what I'm talking about, because for the people who are less aware of how options work and the relationship with the maturities and all that, I'm going to explain this with an example. Let's just go, for example, for the 0DTE first. I'm going to look for a 10 delta strike price. A delta is the inverse of the probability of profit. All right, and so with a 10 delta put, that means that the put will have a 90% probability of expiring without value. All right, so it has a 10% chance of being exercised. Let's go here to our option chain on the queues. Let's just take this out of the way, if it goes away. Right, and now let's just do this to refresh the chain, if it cooperates, of course. All right, here we are. Now, the market is closed. We are on a weekend, so 0DT option is not really available. But let's use the option expiring at the shortest maturity possible, which is next Monday. Let's look for the one, and because the market is closed, as you can see here, the probability of profit will not be available. So we are going to look for a 10 delta put, and this will go somewhere around here. So this is still 17, so we have to go further away. All right, this is probably the closest we can get, 10.6, so 9.9. You see here that this is basically a 10 delta put, 9.9, and the strike price is 701, considering that the price currently is at 723.25. So we will get a 701 strike price. All right, and because of that, let's pull up here our calculator. So a 701 strike price divided by 723.25, which is our current share price, all right? And then if we divide by 1, so in this case it would not be 0DT option, all right? It's a 2-day option, but let's just put here 2-day, right? And you see that for this option to be assigned, the stock has to come down a little bit more than 3%, so 3.1% basically. So we are 3.1% away from the strike. If we bought this share, we will buy only with a 3.1% discount. Now let's go for the weekly option, all right, and see where we are. Again, because next in 7 days time, in a week's time, it's again weekend, so there's not much use for us to look for an option that expires on the weekend because it does not exist. So we are going to see where the 10 delta option is on the chain for expiring on the last trading day of the week. This is even worse because the markets will be closed on next Friday, so these options will expire next Thursday instead. But no man, doesn't matter. So 9.4, we are close. 9.8, 9.8. So yeah, here we are. This is the closest one. Yeah, this is the closest one. Let's see. Yeah, let's go for this one because I think this one is relatively closer. Yeah, this is a bit closer. So 684, all right, and this is the 10 delta option, and so we are going to do this. 684 divided by 723.25 and minus 1. We would be buying a share, these shares at the 6.4 discount, right? So here we would be buying the shares. The stock has to come down 5.4% in order to be assigned. Now, I think you already see where we are going with this, because we have no options available for 3 weeks away, for 30 days away. We have for 34 days, but the closest one is for 27. Let's move further back. See if this is a 6.3, so we went too much further ahead, so we are close. 9.7, this is the one closest, and you can see here we would be buying the shares at 645. This is already a very large distance, as you see. So 645 divided by 723.25 minus 1. So the stock would have to come down 10.8%. This is already, as you see, we would be already in correction territory to be able to buy these stocks. And as you probably, if you follow the markets, you see that the market over the past 2 or 3 years very rarely dipped below 10.8% from its all-time highs. So I think this is a very good strike, a very good position to be in, because for the most part, chances are it will not go below this, and even if it comes, it most likely will happen. You will be likely to sell the shares quickly at break even, or you can get a good capital gain out of this. And so this is how it is. You buy at a better discount, and in this case the capital gains have a much bigger role to play in monthly options, which is good, which is better than just compounding premiums every day with a 0DT option. And so, as I mentioned here, compounding favors 0DTs, but cushion favors monthlies, and monthly assignments get you larger discounts and capital gains and faster recoveries, because after a 10.8 drop, the market will, unless there's a serious meltdown and something very serious happening, the market will not go much further down than 10%, which is the correction territory. And so moving on to the next slide, and this is a dear one for me. For those who follow the challenge, I fell victim of this. I still think that the market was manipulated that day, but that's another topic. And so, lesson number 4: you should never, ever, once after you get a sign, you should never sell a call with a strike below your cost basis. Never. Always at least the same, so that you can break even, or above, so that you can put yourself in a position to get a capital gain. Never below, otherwise you will be locking in a loss, and as we will see, for no benefit, or not enough of a benefit for you to do that. In this case, I know, because I've been in this place before several times, I know that when the stock continues to crash down, you feel tempted to sell calls below your cost basis, so that you can continue to get reasonable premiums out of this. But it's not really worth it for several reasons. And the reason, and I'm going to show you here with another example. Let's go again for the let's just, because it's simpler to explain with options closer to maturity. But you will see here, we can go to anywhere in the option chain, but we will just focus on here. You see here that in this particular put, strike 716, you would receive a premium if you sell this stock, this option. You would get 2.60 per share. So you get $260 if you sell this put, because it's times 100. But let's just assume that our cost basis is this one, 716. And if this happens, all right, you get 616. So for you to break even, you would want to sell at least a call at 716, all right? But if the price continues to drop, what's going to happen is that at some point these calls will not give you much of anything. The premium will be very low. And so you will feel tempted to not choose this one, but to choose another one further down the chain, which would lock your capital loss, but you will get a very good premium, right? But the problem is that, as you can see here, for this one you would get $870, but for each dollar drop in the option chain, all right, so, and each dollar is $100 in your account, you would get only, in this case, you can see here, you'd get from here to here, you sacrifice $100 of your capital to get 35 cents more premium. And but keep in mind, the market is closed, and here you would get something similar, and because you are going further and further away from the money, these prices are not really accurate because they are not real life prices, all right, the market is closed. But as you go further down the chain, you will start to notice that the increment in premiums will become smaller and smaller and smaller as you go further away from the share price. This happens because of the relationship of the interactions of the gamma and the delta, all right, but this is another topic, more complex. But what happens is that as you go further down the chain, the increment in premium that you get for each dollar that you sacrifice will become lower and lower and lower. And so the benefit that you get, that I'm mentioning here, the premium increments that you get will become smaller and are lower than the capital loss exposure that you jeopardize, or that you abdicate, because these prices are not correct. You don't get an increment of $1 in here like it shows in here when the market is open. This is just closed market prices. but this is exactly what happened. And so you should never jeopardize your hard-earned capital for better premiums, because the premiums will not give you enough compensation for the capital loss that you are sustaining. And so the solution for this is basically to sell calls with a longer maturity, because this will allow you to still get some premium with calls at or above your cost basis. Of course, you are trading time for money, so the returns will be lower, because the annualized returns from an annualized perspective will be lower, because any premiums that you get take longer time to be realized, and so the returns will be lower. But it's better to do this and lower the returns that you get from the premiums while keep your capital intact, the capital that you are committing to the shares intact. Now, I know that some of this temptation comes also from the fact that you feel that you can do something about it if the market eventually reverses. But I can tell you from experience, and if you are experienced with markets, you know that this is simply not possible. After a strong downturn, when the market continues to come down and down and down and down, what usually happens is that it needs a match to spark for the market simply start to recover. And then when it recovers, it recovers with a vengeance. Buyers jump in, they start to buy everything in sight very aggressively, very quickly, and you simply cannot do anything about it. And especially so because, as we know, the market is a hunting ground for high frequency traders, which are just waiting for a blip for their algorithms to shoot orders to the market at a pace that no human can match, even if it sits in the front of the screen and does not take his eyes off the ball. It does not miss a beat. And so this is absolutely impossible to control. And by the time you are able to react to this sudden reversal, regardless of being overnight or not, you are already late. And so there is no way you can do this. And also because many times, in the case that I lived through, it was not overnight. It was something that happened. It was a catalyst that happened during the trading day. But many times these things happen. The mood of the investors shift during the night, and so the market already reacts during pre-market trading. But fortunately or unfortunately, I'm not the best. No one is the best judge of that. The options can only be traded during the normal trading period. So it's possible that if something happens overnight, when the start of the trading day, the normal trading happens, your options are already with a very large loss, and there is nothing that you can do to reverse that loss. And so this is something that I strongly advise against, because eventually you will be burned by this. So never put yourself at risk in that regard. Extend your maturities, even if it's needed for a month or more. No problem, go for it, because it's much better to be safe than sorry when it comes to selling calls below your cost basis. Like I mentioned, even if the strike is below your cost basis, you lock in a capital loss for a premium that does not make up for it. And the timing of this video is not the best. If the market was open, I would be able to show you this. But if you have access to a trading platform, you will notice what I'm saying, that every dollar that you jeopardize, that you go down in the option chain, the premiums do not increment in $1, $1 every strike. No, it's in much less, and goes even less and less and less as you go further away from the price, from the current share price. Now, lesson number 5 is that, and this also is related to the account size, you should never put your eggs into one basket. This may sound strange, I'm telling you this because I did this mistake a lot of times during the challenge. Most of the times I got away with it, fortunately. I think you can if you follow the channel, there were many times in which my trades for the day were 3 puts on the Qs, 10, 11, 12 puts on IWM, and call it a day. And no, there was nothing else that I could do. All my capital were on only those puts, and that's it. And this, looking back, and given the experience that I went through with that kind of strategy, this was not good at all. You should always spread your capital across several stocks, or in my case ETFs. For me it's always ETFs, because if you spread, and you spread by dollar amount, not by number of contracts, all right? It does not matter for if you assign or if you enter several positions with 4 puts each. If the collateral that you put in for each of those are very different because of the differences in the share prices. So by dollar amount is always the way to go, never by the number of contracts. And why is that? Because if you spread across 8 or 12 ETFs, for example, when one of them gets assigned, all right, it's fine, because for sure you're not going to get locked down. You're not going to be unable to do any further trades because you were assigned, and this stock, this ETF continues to drop down. That will not deter you from further trading. So what's going to happen is that if the stock continues to come down, the cash that you use as collateral for the other puts, what you can do is that assign or use some of that to sell more puts on the stock that you were assigned. Especially if as I mentioned, if the stock continues to come down. Don't put everything you have all at once. No. If you for example go in an incremental way, is much better, because it gives you, then if the stock continues to go down after you buy for the second time, the third time, this will continue to give you, to allow you to have some available capital to continue to do this until the stock eventually recovers. Because again, ETFs, especially the ones that you should use for this, will always recover. And so you do it progressively. If you sell, for example, 2 puts on a ETF, and the ETF was assigned to you, you have 200 shares. All right. If the stock continues to come down after another 10 or 15% drop, all right, let's go and sell 2 more puts on this. Because then if it gets assigned again and the price continues to come down, if you sell 2 more puts, then the commitment will be much smaller, because your strike will be lower. All right, and so by doing this, you continue to commit less and less cash. The cost of basis continue to come down, and by doing this, you won't need a full recover to sell back the stock without a loss, and this will even open the door for you to get out of it with a capital gain, which is of course much more convenient. And like I said, repeat if needed. And so I understand that this may raise some feathers and raise some eyebrows, because this is becoming a bit risky if you continue to do this 2, 3, 4, 5 times, because the position starts to become very large. And this may be a problem for individual stocks. I had this experience with Pfizer, for example. I remember the situation of Pfizer was quite worrying, because at some point I had 2,000 and plus shares, and it was at some point it started to get difficult to maneuver. But with ETFs, and of course depending on the ETF, but for the ETFs that you should use to do this, it will eventually recover. And I'm talking, of course, about the ones on the main indexes and the ones on the economy sectors. I said that I wanted to show you, and I'm going to do it. So, for example, I have this list of ETFs that I usually consider. Some of those I would not recommend for the wheel again. I use them, but if I would do this everything again, I would not use some of these. So I'm very, very, very picky and restrictive on the ETFs that I would use. But I highlighted these 4 ones specifically because I think these are the best ones for the wheel. And these are from the SPDR, the brand SPDR, because this is for the energy, this is for the consumer staples, this is for the consumer discretionary, and this is for the financial sector. These are very diversified by themselves. They are sector focused, but they have a lot of shares within them. They are priced reasonably so. They are not that volatile. The one from the energy is more volatile, but still, for the energy, for an ETF in the energy sector, this is not that much volatile. You can see here the historical volatility at the time I took this. At the time I took this data, I would say 34% for an energy sector, for the energy stocks. It's very much on the low side. You will be hard pressed to find energy stocks with this low volatility. I mean, individual stocks. Probably the biggest ones like Chevron, ExxonMobil may have a volatility close to this. Probably ExxonMobil being so large, probably it gets even lower. But if you want to have exposure to many energy sector companies with this volatility, I think that it is very, very good. Of course, consumer discretionary, high ticket items are always a bit more volatility because they are much more correlated with the economic cycle, but still 25%. If this was a stock, this would be a very low volatility stock, and so for me this would be a very good pick. And also financials, very low volatility, and consumer staples of being very uncorrelated with the economic cycle because we all need food, we all need other essentials. This is very good. Of course, the premiums are smaller, but at least you get the assurance that it is a safe keep for you to do the wheel with. And of course, because you are diversifying, this is basically some sort of low yield ETF that can be compensated with other ones for higher yields. But again, to come back to the situation of the ETF that happened to me, as you recall, at the end of October last year, I was forced to buy 500 shares of the Qs. I allocated $315,000 of my account to these 500 shares. The stock continued to falter, and because of most of my capital was allocated to this, I could not do anything else. I was locked down badly, and because the price was so far below my cost basis, I could hardly get any returns from it. Because this was such a large position, I could not do anything, and it took until late April to finally be able to get out of the position without a loss. But even so, if you recall this situation, you will remember that you will notice that the last 2-3 weeks before the market, before I was able to get rid of the shares, and I'm going to show here, when this situation happened, when this upswing started to happen, I was only able to sell my shares at around 600, so I sold at this strike 630, and the price was already here between 660 and 670. So until the calls were assigned, I was carrying a very large unrealized loss because I was attempting to sell the shares at break even. And so, because the recovery was so quick, came so quickly, there was simply no time to adjust the strike. Because if I saw this coming and my strike was here, if I was able to adjust my strike here, probably I would have put the strike a bit further up to get some capital gain. But no, because I had already sold the 630 calls because the price was so depressed that I could hardly get any premium on the 630. So I had to extend the maturity for a very long time. Yeah, I had to carry for 2 or 3 weeks a very large unrealized loss until the calls expired, and I was able to get out at break even. So it's not really convenient. It is really not worth it. This is very bad for your returns. So I got, first of all, it is a double whammy. I got very little returns from the premiums, and then at the end, I left a lot of capital gains on the table. So don't do this. Always diversify so that you can then make the most of your money. To keep lowering the cost basis, still always leave some breathing room, and then when the stock recovers, you can still put yourself in a position to break even without being completely committed to only one share or one ETF. And so these are my 5 lessons. For those who stayed around until the end, I'm going to give you a bonus tip. This is something that happened very recently and only applies to those who don't have currencies, who have accounts which are not in USD or are not pegged to USD. All right, for example, the euro. I'm here in Dubai. It will not happen again with me because any deposits that I may make, for example, it will be in Arab Emirates dirhams. The dirham is pegged with a fixed peg of 367 to the dollar, so this situation will not happen again. But if your currency, the currency of your account, is not USD or is not pegged to the USD, please, as soon as you place a trade, convert your money to USDs. And why is that? Because recently I faced a double whammy in a trading day. The market was in a complete meltdown. It came down very aggressively. All my puts went into the money, and usually I leave around 500, 600, 700 euros, so between probably $700 and $1,000 in unused buying power to account for currency fluctuations, because again I was using euros as a collateral against US denominated positions. And so what happened is that this combination was very bad because market crash, so all puts went into the money, and at the same time the dollar started to rise very aggressively against the euro, so the euro plummeted in value, and that means that my collateral in euros at some point was no longer enough to cover the puts, and my cash position, my unencumbered cash position, went into the negative by 20 or 30 euros. This was enough at the end, 10 minutes before the trading day, for my broker to, because I had a very large position in an ETF around $150,000. What happened is that automatically the calls that I had sold on this position were bought back so that the shares could be released as collateral, and the entire position was liquidated and led to a very large realized loss because it was necessary for my cash position to go back into the positive, so I could buy then the shares that I was going to be forced to buy from these puts. Then later I filed a complaint, and the liquidation was reversed because it was completely disproportionate to cover a 20 or 30 euro shortfall, you're not going to liquidate a $150,000 position. So eventually the liquidation was reversed. I got a slap on the wrist because I was told, please manage your risk. Don't let your account again going into your cash position going into the negatives. But now it won't happen again because of this. If you do this, you won't be subject to this kind of situation if it ever happens again. Eventually will. Anything can happen in the markets. But as soon as you place your trades, if you are using euros to cover for those trades, so those positions, please, every broker, Interactive Brokers, has this functionality. Just convert your euros to US dollars, because by doing that, you are doing it at an exchange rate that is consistent with the exchange rate used at the precise moment that your money was posted as collateral, so you won't lose anything, hardly anything. And once you convert, your exchange rate risk is completely eliminated. You have US dollars to cover US denominated puts and or in this case US denominated underlying stocks. So, and then by doing this, you simply will no longer be subject to surprise forced liquidations. And this is it. I can understand that this presentation may have raised you many questions. Feel free to leave your comments and your questions in the comment section down below. You can also get in touch with me on LinkedIn and ask me those questions through there if you prefer. And as always, feel free to like the video and subscribe to the channel. And yeah, I'll see you all in the next video.